Good morning and welcome to 10 Years Hence. Our guest speaker this morning comes to us from Bethesda, Maryland, where you'll be pleased to know it is snowing as well. Barbara Krumsiek is Chair, Chief Executive Officer, and President of Calvert Group Limited, a leading investment management firm headquartered in Maryland. Calvert manages over $14 billion in assets and more than 50 portfolios, including award-winning fixed income portfolios and a full family of sustainable and responsible equity mutual funds. Ms. Krumsiek is Director and Chair of Acacia Life Insurance Company. Calvert and Acacia Life are affiliates of Unify, a mutual holding company based in Lincoln, Nebraska. Her career in the investment industry spans 3 decades. Before joining Calvert as CEO in 1997, she was Managing Director at Alliance Capital Management in New York and was responsible for mutual fund and variable insurance product lines worth over $17 billion in assets. At Calvert, she has presided over a period of strong growth and increased visibility both within the sustainable investment sector and in the financial services industry as a whole. During her tenure at Calvert, Ms. Krumsiek has worked at the forefront in the socially responsible investment area. She has taken a particularly strong interest in areas such as board diversity and gender inclusiveness. Under her leadership, her firm developed the Calvert Women's Principles, the first global code of corporate conduct focused exclusively on empowering, advancing, and investing in women worldwide. These initiatives were recognized in June 2007 when Ms. Krumsiek accepted the Women of Concern Award for developing innovative and precedent-setting initiatives that strive to empower women globally. Ms. Krumsiek has also taken a leading role in the investment issues surrounding climate change. Last year, she was named as co-chair of the United Nations Environment Program Finance Initiative. Barbara Krumsiek is a recognized leader within the business community. She serves on numerous boards and has been recognized with a number of different awards for her service. Graduating Phi Beta Kappa with honors from Douglas College, Rutgers University, she received a bachelor's degree in mathematics. She received a master's degree in mathematics from the Current Institute of Mathematical Sciences at New York University. In May of 2002, Georgetown University awarded Ms. Krumsiek the degree of Doctor of Humane Letters honoris causa, citing her work in advancing the critical dialogue regarding the role of business in society. Ladies and gentlemen, please help me welcome Barbara Krumsiek.
Thank you. It is really an honor to be here with you at Notre Dame today, and thank you, Professor O'Rourke, for that introduction. It gets harder. I need to compress that introduction. My husband likes to say, if I get one more pat on the back, I'll be flat on the floor. So I have to be careful about that. This is my 3rd visit to the Notre Dame campus. The first 2, I came here as a parent because my daughter plays lacrosse for Vanderbilt, and Vanderbilt competes against Notre Dame. Do we have any Notre Dame women lacrosse players in the room? No? Okay, I would have greeted you and probably been a little upset that you beat us the last time we were here in the NCAA tournament. But it is a pleasure to be here to speak about something as important and evolving as the shift from individual conscience to institutional accountability in the area of ethics and sustainability. The evolution of sustainable investing, I think, is a little less about what, I will talk a bit about the history, but I'm much more interested in the shift from the individual to the institution. Your other speakers, I'm really honored to be among your other speakers. I do know Jay Cohen-Gilbert, who was here earlier, last week's speaker, and I happened to notice in January 24th's Washington Post, there was a whole article on benefit corporations, and Jay's organization is cited there, big time, B-Lab. So you're right in the thick of what's happening. I really think this is an excellent array of speakers, all of whom I would love to have the opportunity to hear as well. You heard from Professor O'Rourke that Calvert's an investment firm. We invest about $15 billion. We're now at 43 mutual funds. We have condensed a little post-meltdown the last couple of years to try to focus on building scale and returning to growth. And our funds range from money market funds, fixed income funds, equity funds that span the spectrum, large cap, small cap, international. I'm not going to talk a lot about Calvert's particular investment details, but I welcome any questions during the Q&A. I do want to say, though, that throughout this meltdown, we had no subprime mortgages in any of our portfolios. We owned no CDOs in any of our portfolios. Or CDS, credit default swaps. We owned no CMOs or CDOs either. No Lehman paper. And I get asked a lot, how did that happen? Did you know, when we were at Paulson, who I hear made $5 billion this year from shorting the mortgage market. A couple of years ago, we made $4 billion. No, we didn't have that kind of insight. But what we do have is a really careful attention to governance and risk versus reward. I asked our chief investment officer of fixed income, who is a woman, Kathy Roy, how did you do this? How did you duck all these landmines? And basically, she said the obvious. She said two things, and I said the third thing. The first is, don't invest in what you don't understand. This is absolute 101, and it must have been as interesting to you as it was to me to see the CEOs of major financial institutions say that they did not understand the investment, the particular securities that their institution were offering to investors. Secondly, is the reward worth the risk? And interest rates have been artificially low for 6 to 8 years now. So therefore, to get an increment of a small increment over a treasury rate today is not a good indication of value. Because if we feel rates are artificially low, then the spread is a bit less important as a measure of whether that more risky investment is priced right. So that drove us to avoid some instruments. And then the third, I would say, and that leads into my remarks, is Calvert doesn't follow the Wall Street trends blindly. There's an awful lot in the investment and financial industry about following the crowd and what Wall Street says. And I think what Goldman Sachs offers. And some of these firms have wonderful attributes and great people, but nonetheless, there was this herd mentality. And I think a lot of what Calvert's about is looking through the herd. And the way we do it is unique, it's interesting, and I think is of value to you when you look at your careers and you look at the contributions you can make to business in the coming years. I'm very happy to be here at Notre Dame because of your strong traditions in promoting ethical, sustainable business practices. It seems to me from perusing your website and hearing about your programs at the Mendoza School that you also believe that corporations can be a factor in promoting a better, more just world. Your principles, and largely driven by being a Catholic business school, are very, very similar to ours. In our basic value statements, we value human dignity. We believe that it's important to be a steward of natural resources. We believe labor rights are important for corporations to pay attention to. And we do think there is a role for addressing the poor and the vulnerable in our business practices. I'm especially struck by your Ask to Be More initiative. It really closely matches Calvert's view of personal and corporate responsibility and my own view. Like Notre Dame, I think integrity begins with individual integrity, with the actions that each of us take. And as employees, as members of our families and communities, and many people viewed the financial crises of the last 3 years, the meltdown, subprime mortgage mess, as failures of regulation. Let me go back. And in fact, the study's coming out. I'm sure you all will be asked to read it, but there was a financial task force that the president set up that is just now releasing its report. And it's a lot of blame out there. But I see it much more as a breakdown in personal values. The financial services industry has been one of the most highly regulated industries in the world, if not among the most regulated. By the way, we're also now the least respected because of this, but we're highly regulated. And my experience over 30 years has shown me again and again that rules are no substitute for a culture where people do not do the right thing. We want a culture where people do the right thing. We can't write enough rules and regulations to cover every situation. I am not a fan of increased regulation. But we need a climate in which people are encouraged and rewarded for ethical behavior. And my annual talks on ethics and compliance to Calvert people stress that it's not enough to sign off on the code of ethics. As there's been increased focus on, I personally must sign 4 different codes of ethics for all the boards I serve on and for my work at Calvert. But it's all about what's not in the code of ethics. It's all about the tens and hundreds of decisions that every Calvert associate makes every day that are not covered in that code of ethics, but yet they have ethical content. And I am at their mercy, because if they don't make the right decisions, that puts our firm in jeopardy. And I can only count on their personal ethics to make the right decisions. I can't have enough lawyers writing enough codes of ethics. We can't continue the way we've been continuing with the amount of regulation we've been writing. But we've got to have that corporate culture, and you need to be part of that, because we're just beginning to understand what corporate culture is all about. It's very new, in my mind, in the business schools and in the corporate world. A company's culture that encourages short-term thinking, risk-taking, and corner-cutting is not going to be influenced by one all-employee memo or a poster on the wall in the break room that says integrity matters. Integrity has to come from within yourself and from within your corporate culture. It can't be imposed from the outside. Understanding a corporate culture when you begin to look for a job or assess is going to be part of your challenge. How are you going to determine if that corporate culture is what you're looking for? Now, there may be those who feel that they would like a corporate culture which is all about making the most money possible. And I did work for a firm like that for many years. And when I worked for a firm like that, I understood that culture wasn't 100% what I felt drove me in my professional career. So what did I do? Number one, I ran my businesses with a slightly different take from the other siloed businesses, and would not do certain practices that were not per se illegal, but I felt were not in the best interest of the customer. And secondly, I checked my identity at the door when I came in and when I left. All of my work in gender equity and in community was done outside of working hours. So when I was approached to be considered as the CEO of Calvert, coming from a Wall Street firm where I'd worked for 20 years, a lot of folks said, well, that was a huge switch that you made. And to me, there were 2 great benefits to making that switch. Number one, I didn't check my identity at the door, that Calvert's culture was supportive of the things that mattered to me in my life. And secondly, I felt Calvert was onto something really savvy in business. When you're looking to invest in a company, you're going to look at the financials. You've all learned this. How do you spreadsheet? How do you forecast earnings? What kind of business are they in? What are their growth opportunities? But you also look at the quality of management. And when I would ask my colleagues at Alliance, how do you assess quality of management? What goes into that assessment? I would get what I thought was a runaround, which was when we look at the financial track record of those in the leadership. And I said, well, haven't you already counted that in kind of looking at the numbers and looking at the history and the future? I think what Calvert does is really assess quality of management. So I believed we were onto something as a company, and I believe we were onto what I think is the next point here, creating more effective organizations. That how do you determine if an organization is truly going to be sustainable and effective? One area where we've been pioneers at Calvert is advocating for stronger governance. For most of the past decade, we've been pushing companies to add more independent directors, especially more women and people of color, to their boards. A little bit of history. We started in 2002, the year Sarbanes-Oxley passed. And it's, when regulation does come down the pike, you can try to fight it or roll it back or repeal it, and there are lots of advocacy groups that work in that direction. At Calvert, we often say, where's the opportunity for us in this? And we felt there was an interesting opportunity in Sarbanes-Oxley, which is the mandate that there be more independent boards was going to, one of our analysts calculated that there would be something like 8,000 new independent board members named in the next 2 to 3 years in order to satisfy Sarbanes-Oxley and New York Stock Exchange listing requirements. And why is that? Well, Corporate boards, a secret. I'll share as many secrets as I can. You're welcome to ask me any others about how business works, but no one ever resigns from a board, very rarely, very rarely. So if a board size is 10 and you only have 6 independents, you're going to need to get to 7 independents. It's very unlikely that one of those 4 affiliated directors will resign. Very unlikely. So the board sizes would grow. That was our estimate. So there'd be a lot more new board seats created. And therefore, it was a great opportunity to open doors to perhaps non-traditional board members, qualified female and minority candidates. So what we did was we wrote model nominating committee charter language, focusing, I think I went a little fast on that, but focusing on inclusive interview process. Those sports people in the room, and if you're at Notre Dame, you're a sports person, it's the Rooney Rule. You know, you interview diverse slates of candidates, and guess what? You'll hire some of them. It's the way it works. If you aren't interviewing and looking at a diverse slate, it's very hard to break through the pattern of interviewing people you know or people you do know. And that becomes a pretty closed loop. So by issuing the model nominating committee charter language, we help formalize the commitment to board diversity, advising, and we feel we actually played a role in blipping the number of women on boards in the next 2 to 3 years, went from 14 to 16%. And we think that our letters, by the way, I wrote to 4,000 companies with this model charter language. That's the number of companies we follow. And of course, I didn't sign every letter. It was a pen, but I wrote to all those companies. We do think we made a difference. A year later, we launched our Calvert Women's Principles, as you've heard about, and provided investors with a set of tools to help them assess corporate progress on gender equality. And why did we do all this? It's not just a nice thing to do, not just the right thing to do. It has the benefit that I think it is the right thing to do. But it helps companies make better decisions and improve performance to have in the room a diverse set of viewpoints. I look out at this audience and I see diversity. You want to work in companies, look around. You want to work in a company where you see this same diversity. It's so additive to the success of the company. And wherever you work, you're going to want the company to be successful because that means opportunity for you. Diverse boards look more critically at corporate strategies, often not as likely to go along with questionable practices just because everybody's doing it, and that's the way it's always been done. A growing body of research shows that including women at all levels of the corporate structure enhances results. A McKinsey study found that companies that had at least 3 women on their senior management team outperformed their peers significantly on a broad group of management excellence measures. I don't know if you all are following the Davos conference, which is a gathering of corporate leaders globally. They just this year introduced a suggestion to their corporate members that if they send a delegation of 5 or more, that they include 1 woman in that group, just this year. So this is not an issue that's behind us. I mean, the fact that many of us have benefited from educational experiences that are now co-ed that were previously not open to us, or have benefited from participation in sports, for example, Title IX, that were not previously open to us, doesn't mean that it's past, because the culture is what drives the future. And those legal changes are enabling changes for a cultural change. Another study sponsored by Catalyst in 2007. Am I behind on this? I might be. I apologize. No, I'm up to pre-tax net income. I am really sorry that I'm so far behind on this. But anyway, if we're on the right slide, between 2001 and 2004, Fortune 500 companies with the most women directors averaged 42% more pre-tax net income per dollar of revenue than companies with the fewest female directors. Companies with the most female board members had a 53% higher return on stockholder equity and a 66% higher return on invested capital. So my own nuance on this, though, is that the women that are getting on boards now are those who are quite accomplished. You don't have as broad an array of women candidates. So I personally do not subscribe that forever companies are actually going to do better with women on their boards, but I think they will certainly do as well. There's no detriment to including, to having diverse boards, and there might be actually great benefit. As of today, 38 of the top executives of UN Global Compact companies, and I know you have a great relationship with the Global Compact in history dating back to 2000. These companies have come forward to support gender equality and women's empowerment. Our women's principles, which you can find on our website, www.calvert.com, were adopted by the city of San Francisco in 2008. And in 2009, we urged the SEC to incorporate diversity measures in their newly enhanced disclosure requirements, which they did in 2010 by asking that companies begin to report whether and how they considered diversity in their board selection processes. Now, a company is fully entitled to say they don't consider diversity. That's okay. I actually have no problem with that. I don't care if they say they don't consider climate change or they don't believe in it. I just want them to disclose that, because I, as an investor, might feel that's important to me. If I don't feel that company, some investors don't care. They may not care. But disclosure is not about politics and taking a point of view. It's about telling people how you're running your company. And so I do believe disclosure is a great, we'll get to that more about disclosure. But it's not telling you to do something a certain way. It's just saying, how do you consider it in your activities? Our women's principles were donated to the UN last year because we felt we're not a company that writes codes of conduct or we're not a not-for-profit. Nobody was doing it, so we just did it to help our investment analysts. But the UN was poised to really take it on as part of their UN Women initiative. And so we donated the intellectual capital to them, and they have incorporated that into their Global Compact activities. Another element of your Ask to Be More initiative is the greater good, and this is the idea that businesses, organizations, and institutions can reach beyond their own narrow interests and join together to create positive social change. And that's something I think that Calvert and the whole sustainable investment community has been involved with since the start. It's also an area that's undergoing some very rapid, exciting changes. To skip through some of those changes, the UN Global Compact is a 10-principle set of sustainable ethical behavior. And when a company signs the compact, its management agrees to meet global standards for ensuring human rights and labor rights, protecting the environment, and rooting out corruption. And thousands of companies have signed on, and many in the emerging markets, which I think is very important. Brings many different types of organizations together, companies all over the world, investment firms like Calvert, government, NGO agencies, and even business schools like Notre Dame. And we're involved primarily through our work on the women's principles and UN Women. But we've got to teach the next generation. We've got to let the next generation teach us. And your involvement is really part of how I believe we will unfold in the next 10 years. So there's a pattern in ethics and sustainability. Starts with individual integrity and personal conscience. Grows to encompass our businesses and our institutions, those we choose to work for or invest in, and those we can influence. And finally, it expands beyond any single institution in global cooperative efforts to support the common good. So that's the history, actually, of social investing as well. Began with the individual, extended to the institution, and finally transcends those institutions. We're at a turning point for sustainable investing. You heard a bit about the B Corp last week. We're not immediately jumping on that bandwagon, but we do think it has incredible potential impact in the way companies are organized and how they behave. I've already had some Calvert investors say, when are you going to launch a mutual fund that invests only in B Corps? And that day may come. That's my 10 years out. There may well be a mutual fund that just invests in companies that have registered as B Corps. And there will be investors that want that. But to give you a bit of the history of sustainable investing, it goes back centuries. And it started in religious movements. And it began really around sin stocks, avoiding tobacco, alcohol, gaming industries. But modern SRI started to take shape around issues of rejecting company behavior, to take you way back to the 70s, avoiding companies that might have made materials for war, harming the environment. Earth Day, the first Earth Day, was in the 70s, making unsafe products. The real watershed for social investing really came in the early 80s, both around the environment and around South Africa. I do want to talk a little bit about South Africa because that's really when Calvert began. Calvert was the first mutual fund in 1982 that would not invest in companies doing business in South Africa. And divestment became a big movement and really helped advance the anti-apartheid movement, but Calvert was the first. And this is a really important moment for me at Calvert. I had been there a few years, and in 2000, I was out, not in the office that day. We give one paid day of leave a month to volunteer in the community. That's on top of your vacation. And we try to walk our talk as a management team. So I was out of the office downtown Washington, and I got a call from the head of communications at Calvert, and she said, "You're not going to believe this. The First Lady of South Africa just called, and her people called, and the First Lady would like to, she's in town with her husband, Thabo and Becky, for their first state visit with then President Clinton, and she wants to come to Calvert." I said, "You're kidding." Well, you know, working woman, I have my heels in the back seat of my car, change my shoes, you know, run back to the office, and we greet the First Lady that afternoon with her group of her staff. And it was just so important for Calvert people to know that what they had done almost 20 years earlier had resonated and been known in that society. And actually, Calvert's going to get an award from Shared Interest, an African micro enterprise organization, this spring, again recognizing that sort of seminal moment in 1982. So this was one of the Calvert's first sort of attempts to affect global public policy through social investing in a way that we thought was actually good for business and certainly good for society. The environment is another very important evolution of, there was South Africa. And now we're into things like product safety, workplace consumer protection. When we certainly look at recalls of Toyota, you can think of that as a financial issue. We can also think of it as a product safety and awareness and perhaps their work processes issue. And lastly, really reacting to the corporate scandals, we've put a lot more emphasis on disclosure and on good governance. Our screening process for companies in our signature funds, we do look at governance and ethics. We look at workplace practices. We look at whether there are women on the board and in management and minorities on boards and in management. Are there comprehensive benefits and training opportunities? We look at environmental impact. It's not just sort of minimizing your negative impact, but also contributing positively by designing green products or addressing climate change in your risk assessments. Product safety and impact, avoiding companies. We still avoid tobacco, and in some of our funds we avoid alcohol and gaming, but tobacco is something we do avoid throughout our funds. We look instead for companies that make safe, healthy products consistently meeting regulatory standards. Human rights issues in global overseas factories. My dream 10 years from now is that when you buy a garment, it would be like when you buy some food and you have the barcode, and you're going to hear this from other speakers because I didn't invent this, but I think it's a great idea. When you scan the barcode, it doesn't just give you the price. It gives you some indication of the factory it was made in, the country it was sourced in, and their practices. And I'm betting that the U.S. consumer would be much more interested in buying a product that was produced in a factory that did not use child labor, in an environment that was certified to be fair to its workers, and from a company that is treating the environment properly in the way it produced that product. I'm just betting. Now, price is important, and we've seen that, but if you combine price with all these other metrics, I think there is a sense that we will all move in the right direction. New screen for us is Indigenous peoples' rights. We seek out companies supporting appropriate economic development in areas that they work in, respecting Indigenous territories, cultures, environment, and livelihoods. And finally, community relations. You might say, well, does this cost a lot? We figure it costs 10 basis points to do this, above and beyond what others spend. And so our profit margins may not be as big as other firms, but they're certainly, we challenge ourselves to achieve returns that are at or above industry averages, grow at or above industry growth rates, and we do think it's doable. We have a staff of 20 analysts that follow companies in these areas, and they are increasingly becoming CFAs and combining the financial analysis. Historically, we've had to rely on two sets of analysts, the financial analysts and the sustainability analysts. And what we're finding, and two, this is a trend for you, is that these are coming together. And we think more and more, if you have aspirations for working, for Morgan Stanley Asset Management or Goldman Sachs Asset Management, your ability to combine these is a tremendous strength in your application process. And I'll get to that, because we got a lot of new competitors at Calvert. When we started, we were pretty much out of the mainstream, but we're at a tipping point now. Things are changing. It's just been an explosion of interest, not dollars yet, but interest among institutional investors, investment firms, and individuals. And as these strategies move to the mainstream, it's often a business decision, and I don't pass judgment on that. If you just think it's good for business, to me, if it's the right thing, I'm glad you're doing it. If it's because you do think it's a moral decision or ethics, that's fine too. But for whatever the reason, there's just been an explosion. So it brings us to the present, a tipping point when sustainability may well become the standard. Again, I said there's not a lot of dollars yet. We think there's been quite a growth rate, 380%, but that's from a very small base of probably about $3 billion. The market as a whole for investments, for asset management, is now over 25 trillion. So an increase of 260%. So sustainable investing has beaten the growth rate, but from a very, very small base. But we're getting there, and I do think this interest is going to turn into actual investment dollars flowing into sustainable investing. There are 5 drivers of this growth. They're not necessarily distinct. They kind of grow on each other. First, and it's not just because I'm at Notre Dame that I'm starting with this, but the academic support for SRI is critical. We like to think that a lot of things are invented by business. They're not invented by business. They're invented by you. The academic world creates a lot of great breakthrough thinking in finance and in business. I just want to sort of comment on a couple of studies that I have particularly liked. There are studies that show companies that meet the highest environmental standards tend to have higher valuations that do not. I don't have actually the university from which that one came. My absolute favorite study is Working for the Woman, Female Managers and the Gender Wage Gap, Philip Cohen and Mark Huffman, University of North Carolina, Chapel Hill, and UC Irvine, November 2007. And what that said, because pay equity has been a very thorny issue for women in the workplace for many years. 76 cents on a dollar, stuck for many, many, many years. And when something's stuck, as a mathematician, I think it's a closed system. There's something wrong with the system. I don't think the answer is Lilly Ledbetter Act. I don't know if you've studied that. I don't think the answer is more regulation or monitoring or controlling. I mean, that's a patch. That's because what this study did was looked at, it surveyed 2 million working women in this country. And it basically studied their pay equity statistics. And what the study concluded was that it wasn't about the number of women in the workplace. A lot of EEOC monitoring and regulatory regimes count. They count. Okay, so how many women professionals do you have? How many women do you have at every level of an organization? And what this study found is that was not the driving factor for pay equity. Pay equity rose to over 90 cents on a dollar when there were women in senior management. If there was a woman among the top 5 paid people in the company, there was pay equity. Why is that? I don't think people are ill-meaning in these things. I really don't. I don't think people set out to disadvantage certain other people. I am an optimist. I believe that. But what happens is if you have the 5 top paid people don't even think about pay equity as an issue because it hasn't been an issue for them, then it doesn't get raised. If you have a woman among the top 5, it's more visible. There is someone watching the data. There is someone commenting. And I do think people do the right thing when it's brought to their attention. I have to believe that. I do believe that. So that study I thought was fascinating, only 2007. And now you see a lot of the Women Catalyst and other organizations picking up on this women in top management issue, because that will solve the issue of pay equity. Forgive me for another sports analogy, but you have a problem with your knee. What do all the physical therapists tell you? And my daughter was always working on something as an athlete. Build up the muscles around it. Yeah, you got to deal with the knee, but if you build up the muscles around it, guess what? That helps you. Well, a lot of problems in business are not about tackling the knee. It's about building up the muscles around it. So this, to me, this study was really, really critical. So tipping point one is academic support for SRI. Second is growing institutional demand. Right now, it's a lot about talking. Well, we are able to get a meeting with the treasurer of almost any state pension fund, the treasurer of any state regarding their pension fund. Calvert picks up the phone, calls treasurer of the state of Pennsylvania, says, we'd like to meet and tell you what we're doing at Calvert. Guess what? We get those meetings. We just tried it a year ago. Just picked up the phone. We met with the treasurer of the state of Florida, New York City Controller, Pennsylvania, California, CalPERS. We get those meetings. We haven't seen any dollars yet. They want to know what we're doing. It's remarkable. There's an extraordinary acceleration of the trend of interest in large pension funds wrestling with issues of how and whether to incorporate ESG factors, environmental social governance, into their investment policies. And it's even happening globally. The Japanese government pension fund, GIPF, with more than, I think it's 1.3 trillion in assets, is said to be considering ESG. And one of the largest Japanese trade unions, known as Rengo, recently announced that it intends to build ESG analysis into its member funds. Another tipping point, greater disclosure. As more and more investors screen for ESG factors, the demand for transparency increases. And I do think transparency and disclosure are keys to improved performance. Sustainability reporting has become the norm, not the exception. And more competition, more institutions, as they demand more sustainability focus, investment firms are looking at it. So BlackRock, Goldman Sachs, UBS, Deutsche Bank, and in particular, and then the specific generations, that's the one that Al Gore started, very into sustainability as an investment focus, really to deliver performance, not just social impact. And then the fifth tipping point, a larger pool of companies interested, management of companies. We launched something called SAGE, Sustainability Achieved Through Greater Engagement, 2 years ago. And that's where we'll own almost anything. We still won't own tobacco, but we'll own any company. And in fact, this past year, we owned Royal Dutch Shell, BP, Dow Chemical, GE, Walmart, companies that we might not own in our signature funds, simply because we believe that those managements are ready to talk and meet with us and really move forward. As a member of a financial institution, financial industry, I do think we are drivers of change. And I do think this change can be change that positively affects society and as well as the companies and communities they serve. We can do this only through cooperation and collaboration. Corporations, investment firms, governments, non-governmental agencies. We need to have all elements of society working together, and I think we are seeing that more and more, and we are seeing the fruits of that moving forward. I'm jumping through this because I really want time for questions and answers. I've spent really most of this time talking about the changes that are underway in the SRI world, how we're quite possibly at a pivotal moment where sustainable investing enters the mainstream. So what next? What will the world look like in 10 years? What will happen if all of these factors are an integral part of the investment process? Are we really that impactful in influencing society? I actually think so. Because of all the reasons I've mentioned that have to do with good business and delivering results. But I also think it's because of you and your generation. Your generation is the next driver. The boomers, now you start to see every other newspaper talks about the first boomer turning 65. See, 35, 65 is the new 35. But you will drive the change. you will start to insist that the companies you work for and the companies that your company does business with are companies that you're proud to be associated with. Not just because they're paying you a good salary or a good bonus, but because they're having a positive influence on your families, your community, and the things you care about. This is going to put increased pressure on companies to do better. That means better environmental practices, smaller carbon footprints, fairer treatment of workers. But it also means the bar will be raised as more and more of you insist on what makes a good company. And that is going to move forward dramatically. So we've come full circle. We started with individual conscience. We moved through institutional conscience, and we're back to the individual driving the next 10 years. I am encouraged. I am thrilled to be with you. And I am excited to be hopefully on the landscape to watch what you're going to do in the next 10 years as you move out from Notre Dame and move into the world even further than you have already, and begin to really be the drivers and those who are up here 10 years from now, speaking about what's going to happen the next 10 years. Thank you for having me with you, and I really appreciate your attention. Thank you. Now, I would really like questions. I know it's hard, but somebody must have a question.
Hi, my name is Rachel. I'm in charge of one of the dorms here. So
Oh boy.
I was really interested in the study you mentioned, and I didn't catch the name of it, the one about pay equity and how 90 cents on the dollar. Do you know which one I'm talking about?
Yes, I know exactly which one you mean. Did you want me to, you want
Yeah,
the citation?
could you tell me, yeah.
I think I should get a commission from these authors, though. I really love this study. All right, I hope the next questioner is lining up their question while I'm looking for this.
Thanks.
Working for the Woman, Female Managers and the Gender Wage Gap. Cohen, C-O-H-N, and Huffman, November 2007.
Hi, Justin Asuncion, undergraduate finance program. What kind of expense ratios do you have on your funds, and how does that compare to the industry average?
Question is expense ratios in mutual funds, and they're high. They're higher. I mean, they range from, I guess, 60 basis points to maybe under 2 for an international fund. Our funds are smaller than, I mean, we'd love to have Vanguard's size and scale, so that drives a little bit of the expense ratio. I mentioned that sustainability costs us about 10 basis points. And the other thing we are is we're a little more complex than a typical firm. A lot of investment firms will focus on limited number of strategies, but because of our approach, we want to be able to offer investors a whole range. In other words, if you would like to be a sustainable investor, maybe you'd like actually a bond fund and a small cap fund, a mid cap fund, an international fund. And so we offer a lot more funds than a typical firm our size. So that drives our costs too. But we'd like to bring them down. We did reduce 6 funds this past year, the expense ratios. Is that your question? That was, yeah. I want the women to ask questions too. I mean, I'm a working mom. I've got 2 daughters. They're 22 and 19, both in college. I have never taken a break more than 3 months in 30 years, over 30 years. If anybody wants to ask anything about what it's like to be a working mom, that's a specialty of mine. I learned the hard way.
Barbara, you raised an issue a little earlier regarding quality of management. In the world of corporate reputation, which is considered a strategic asset that's both measurable and manageable, quality of the management team and quality of leadership turn out to be an important factor in assessing reputation, kind of soft side of non-financial indicators. You mentioned looking at financial performance on the part of these managers. What else do you look at? How do you measure it? And how do you arrive at conclusions that one management team is better perhaps than another?
Right, well, I think that really gets at the heart of what we're doing. It's an indirect assessment. Someday there might be direct assessments of management quality. But from my point of view, if a good financial manager drives, makes decisions that drive the stock price. And unfortunately, the periods over which we're measuring stock price performance keep getting shorter and shorter to the nanosecond, right? Flash crash. That was to the micro nanosecond or whatever. To me, quality management is management that can make decisions that are not going to show up in the stock price, but will affect the performance of the company over the long term and the sustainability of the firm. And that means people who are running the company to be aware of long-term liabilities and long-term issues like environment or workplace. If you can do both of those, if you can drive stock performance in shorter periods and performance that will affect practices in the company that will affect the long-term health of the company, that to me is quality of management. So I think we're assessing it through this side door of environment and workplace and human rights and other things that people think, well, why is that part of your business approach? Well, it's because it will ultimately affect, as it affected Reebok when it was making soccer balls with children in Pakistan or whatever. When those things come out, that knocks the stock price. That's not a good practice. So management that's clueless or unaware that these things, that doesn't understand that these things might impact, is probably not the highest quality of management. I don't know if anyone in your coursework has read Daniel Pink, but I'm a fan of the book Drive. I don't know, has anyone here read Drive? Well, you can put that on your reading list. It's a really short read, and it's very interesting. But it is about human resources, looking at the way people work and how that's dramatically changing, and what people are motivated by, what motivates workers, and how you should run a workplace to really try to keep that motivation up. Oh, I am eager to get more. There has got to be somebody that doesn't think that what I'm talking about makes
My name
sense.
is Holly, and I'm in the MBA program here.
Hi, Holly.
And you mentioned some of the key drivers of SRI, and I was just wondering, from your perspective, if there are any obstacles you see out there or hiccups in the road that might be ahead, and just how your group would address those, or just your opinion on that.
Well, I think the obstacles to including sustainability both at a corporate level and in an investment philosophy are some of the objections really are that it costs too much and that there's a cost to it. And there's some conventional wisdom in financial theory that says you don't spend money on anything except the issues that drive shareholder value, and there's some definition of that is very short term, that is not longer term. The second objection is that it underperforms, that when you incorporate these factors, you are somehow reducing the performance of your portfolio or your investments. And I think the only way to combat that is over time is to demonstrate it's not true. And I'd like us to have the scale where we can demonstrate the cost issue a little better. I think a lot of companies, GE with their eco-imagination, are certainly saying that the opportunities outweigh the costs, that they're driving towards a new vision for and I think that's why tipping point thinking is important, that you need sort of 30% of something to really move it to the next level. So we're not there yet with sustainability implementation in companies or sustainable investing, but we're getting pretty close. But there definitely are objections out there, and I would love to see financial theory really address that sort of some of the basic Milton Friedman type thinking and rethink the basic theory. And that's where, again, the academics come in. Because we don't have time to think. We're too busy. We're too busy doing everything else to run the company.
Hi, my name is Ali. I'm also in the MBA program. You mentioned that you're now looking at investing in a larger group of companies that you wouldn't otherwise have done before. Could you talk a little bit more about that? Are they subject to the same screening process? And what's the rationale behind doing that?
Well, to put it in perspective, we run an index, the Calvert Social Index, that looks at the 1,000 largest companies listed on the New York Stock Exchange and NASDAQ. And every year we reconstitute the index. And of the 1,000 largest companies, if you apply all of our criteria, 650 of them pass. So about 65% of the universal large cap companies are eligible for an investment in a Calvert fund. And we felt that 65% was a robust enough group of companies that we could outperform benchmark averages. And we have, like a lot of firms, sometimes we outperform, sometimes we underperform, but over the long run, we thought we should achieve at or above benchmark averages. But what we found is those other 350 companies, are drivers of they're important to look at as well. And we had no vehicle for really kind of investing in them and working with them. And yet many of them had expressed a desire, let's take Coca-Cola, to be a better corporate citizen and to really run their operations and run their water use more efficiently and appropriately. So 2 years ago, we launched SAGE, where we said, and it was a big step for a company like Calvert to say we will invest in these companies that otherwise don't fall into that 65%. But what we will do is we will engage with, we know that they're ready now to talk to us. We'll engage with their management. And if you don't really own the stock, you don't have the standing to really, as an investor, to really engage. You're not on the you're not on the investor relations radar screen. You don't have proxies to vote. You don't have a standing. So by owning, we have a standing. Now we still are picking companies that we think are going to deliver a good financial return. But our large cap value fund, which is the one we launched 2 years ago, owns about 80 names. 60 of those names actually are passes. In other words, they're not excluding companies that are good companies by all our screening. But of the other 20 companies, we have 16 high-level engagements underway as we speak. And like I said, people want to talk to Calvert. An observation we made leading up to the new product development launch was that a lot of companies wanted to come talk to us that we didn't invest in, but we're not consultants. There's a conflict of interest from our point of view, which of course the ratings agencies didn't, they had a conflict of interest too. They collect money from the people they rate. We don't collect any money from companies that we consider investing in. We have no consulting business. We make all our revenues based on assets under management. So here we were having companies that wanted to meet with our analysts, wanted to hear how we assess them, wanted to know why we didn't invest in them, all this. And I said, well, this looks like a new trend. This never used to happen. The Dow wants to come talk to us, and Walmart wants our executives to come out to Arkansas and meet with them on workplace practices, and Waste Management wanted one of our executives to come down to Florida and meet with them and talk to their team on environmental issues. And we don't get paid to do this, but if we invested in these companies, we could have some standing to be talking to them. So that was really the realization that companies, it was one of the tipping points I mentioned, that companies are more interested in what we're doing. So we launched that strategy, and we do believe these engagements will lead to some change. I will point out, we stumble. We were invested in BP during the oil spill. We came under some criticism for what were you doing owning BP that clearly had unsafe, safety. They were not following their own safety and risk management practices. So, defensively, our head of what we call sustainability policy, who had been the one involved in the strategies there, we were working with them to really have a board-level focus on safety. We wanted a board-level committee. We wanted a board-level because they had some safety issues. But then this happened, before there was really any meaningful change. So we took our lumps on. We're not perfect, and we think we were doing the right thing in investing in them. But we did divest of them at the end of June because we just felt they really had fallen down on the job. But it's a very new area for us, this notion of SAGE, sustainability achieved through greater engagement. But we think it's really the direction of the future. Oh, we got a couple of hands. Oh, here, and then we have somebody up there next. Thanks, Gene.
Hi, my name is Aaron Britton. I'm with the MBA program. I have found that it's very difficult for a regular everyday person to get involved in impact investing, which I felt is kind of a shame. because I think that there's a lot of people out there that want to get involved or maybe don't know how to get involved. One thing that's really impressed me about Calvert Foundation is that on your website you have your community note that people can hop on there, get involved there. I'm just curious, how has that helped your organization, and what is really kind of the trend around that community note? Do you feel that regular everyday people are investing more in this exposure is going to continue in the future?
Well, thank you for that question. The question's about the Calvert Foundation, which is an offshoot of Calvert. It was started about 14 years ago. And it's a foundation that doesn't make grants, it makes loans for community economic development. And Calvert, when I got to Calvert, if you picked up a Calvert report on our holdings, our semi-annual report that shows every investment, about 2/3 of the investment were tiny little microloans to local community groups because we invest 1% of our sustainable mutual fund assets in community investing. And one thing that our lawyers did, and Calvert provides a lot of pro bono support to the foundation, but it is an independent foundation. I'm on the board. And in fact, I did not save this piece of the paper because of the B Corp, which you heard about. I saved it because we just named a new president of our foundation, and she had a nice profile in the Post. So Lisa Hall is the new president of the foundation. What we did was our lawyers figured out a way to file in the states a security that would commingle these community loans. So now, if you want to invest in local communities, and it is below market investing, this is not market rate, you can put really a very small amount if you choose to. In fact, we did an arrangement with Microplace, which is part of eBay, where you could actually, for as low as $25, invest in micro lending. So we have this community investment note where you can get a diversified pool of these community loans, and there is capital support for that. It's run more like a bank where we do have some equity. The foundation has some equity behind that. So I think there are these are new investment instruments being created, and there's a lot of that thinking going on, where you're creating a new way to have an impact in the investment world. I think we're up to $500 million, $500 million in our foundation, and that was significantly enhanced this past year because we got $200 million from Citibank to invest in community organizations that are creating jobs. So of the $500 million, $300 million or so are driven by both Calvert's investments in the foundation as well as individuals that own notes. But $200 million is driven by major institutions. So this is just the tip of the iceberg. By the way, the foundation seems to be hiring a lot more than Calvert's hiring. They're growing leaps and bounds. So check our website for jobs and opportunities, particularly in the impact space. I really give a lot. I'm on the board, but it's one of those boards where I just feel I benefit so much from what the leaders of that organization are doing to advance impact investing. Thanks for that question.
Hi, my name's Maureen, and I'm in the undergrad program. And you referred to your prior job saying that you had to check your identity at the door and weren't motivated by perhaps what motivated the company as a whole. And at the same time, you had your family at home. How did you deal with that?
Well, I have a few tips for working mothers. And I'll share them because you've opened that door, which is how did I handle checking the identity at the door? First and foremost, you have to have a supportive family situation. It doesn't have to be, necessarily a spouse, a partner, a family, a supportive situation, because it isn't about just arranging for the routine. It's arranging for the unusual. And that unusual when you're a parent is all of a sudden the school closes because, something happened. I remember in the Washington, D.C. area, it might have been before your time, but there was a sniper, and there was a terrible period of time and the schools closed, and all of a sudden, you need your support system. So you need a supportive system to really manage your world. Secondly, as a working parent, keep your geography tight. And this just isn't for women. This is for guys. Everyone seems to have this dream of the big house and, the suburbs and all this. And I started out when my husband and I, our first daughter was born, I had about a 45-minute commute to work. But as soon as my daughter was 2.5 and in preschool, and I wasn't there for the 30-second long Halloween parade. I wasn't there to see that. You know, first of all, your children get old enough to say, how come you weren't there? And the famous thing is every parent was there, which is never true, but every parent was there and you weren't. So we moved into Manhattan. We gave up space. We had a house. We gave up space. We had an apartment. But there is a value to time. This is another intangible that people don't factor in. I picked up an hour a day. That was so valuable to me in terms of my quality of life and my, you know, I could walk to work. I mean, I lived in Manhattan, very close to Alliance's headquarters, you know, on Avenue of the Americas. And people say, we raised your children in Manhattan, and, you know, till they were 5 and 8, but it was fabulous. It was fine. It was great. And I think trading space for time is a very big factor. And I did join organizations that made me feel good about my values. I joined the Women's Economic Roundtable, Financial Women's Association, got me into contact with others in my field. I also belong to more generic. I'm a member of the Economic Club in New York and Washington. But I think it's about really understanding your priorities. My daughter, who's now 22, once said to me a couple of years ago, I overheard her say to one of her friends, my mother doesn't cook. And I interrupted her. I said, of course I cook. I just haven't cooked since you were born. And, you know, that was the choice I made. We might have had a little bit more takeout than most families. But, you know, it's about understanding what your own priorities are and trying to live by it. I don't do a lot of things that, for me, my family and my work are the two areas that I spend all my time. I don't miss a lacrosse game. I'm not going to be on your campus this year because I believe Notre Dame is coming to Nashville, Tennessee. But I don't miss a lacrosse game. I build them all into my schedule, try to plan trips around where my kids are and what they're doing.
Hi, my name is Daisha Balloon, and I'm also in the MBA program. And my question is probably more applicable for the women in the audience, but would you mind sharing some of the challenges that you've encountered along the way to becoming a woman CEO, or perhaps conversely, some of your key achievements or key decisions that you made to help you or to help propel you to where you are today?
I think there were three, and I do think a lot of career comments are applicable to everybody, but I do think there maybe are some special comments for women. First is, when you go into a job and a career, and I was this way in the 70s, you think it's all about talent and that it's a process of merit. It's a meritocracy. That if you do a good job and you do a good result, you're going to get the salary increase, the promotion, that it's a meritocracy. And I would say I sincerely believed that for probably 10 to 13, my first decade in the workplace. And then all of a sudden things start to happen that don't seem to relate to that. And for me, that kind of aha moment happened to occur when my first daughter was born. And I actually had, in the late 80s, a boss say to me that his wife had told him that women that really cared about their children stayed at home with them. And I laughed because I thought he was kidding. He wasn't kidding. And, I have a little bit of naivete that I think has carried me through because I just couldn't believe it. And there was no law on hostile workplace at that time. So he cut my department in half and he gave half to a guy that had worked for me. And when I came back after a very short maternity leave, 3 months, I thought pretty short. It was remarkable. I was dumbfounded. So the second part of my career was really this awakening that there's other stuff going on. I joined the Financial Women's Association. I joined some organizations, got involved in leadership on some boards, not-for-profit boards. And I actually helped write a course for the Financial Women's Association with some friends on understanding corporate politics, beyond competence. We called the whole thing Beyond Competence, because there is a period in your career when it's not about competence. It's about a lot of other stuff, and managing difficult bosses, managing subversive subordinates, understanding corporate culture. And that was a really formative period in my career. And I frankly think it's a period when a lot of women drop out of the workplace because it's tough. You know, it's not about delivering that great next product. It's not about something sort of measurable. And I think the pressures can be very severe 15 years into a career to say, you know what, I don't need this, and I want to spend time with my family. So I'm concerned about that. I was shocked. I was up at Harvard Business School participating in a program for the women MBAs students about 5 years ago. And one of my fellow speakers, we were kind of hanging out in between sessions, shared with me, and she was an HBS alum, that there is, I think it's the early 80s, there's some early 80s class of Harvard MBAs, and these women would be younger than me. All the women in that class were out of the workforce. There was not one of them in the early 80s that was still in the workforce. And I was so disappointed because there's so much talent that's on the sidelines. Then the third part of my career is really leadership, is putting my hand up in terms of willingness to consider leading a company. And when I was contacted by a search firm, Russell Reynolds, about leading Calvert and really making that leap, I think the last phase of my career, and I'm still in it and I'm still learning, is leadership. Is the last 10 years. But leadership, you know, you lead in small ways throughout your whole career, but I really say it's become the dominant theme of my world is about how to be a really good leader and how to continue that. Whoa, way up top, way up top. How many think they're going to work on Wall Street at some point in their career? Any aspirations? Higher, 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 higher. Not as many as I would have thought. Okay, good luck. Keep in touch. Yes?
All right, hi. To what extent have you been able to apply what you learned through the coursework of your mathematics degrees to your career, and how beneficial have these degrees been in the business world?
And who are you and what are you studying?
My name's Ethan, and I'm an undergraduate accounting major.
Accounting. Great. A lot of accounting jobs. Huge number of accounting jobs. I thought I would get an undergraduate degree in math, go on to get a PhD and teach. I was accepted into Johns Hopkins for a PhD in applied math and teaching fellowship and all that. And I left school early because I'm first generation college in my family, and I was paying my own way. So I finished up in January, and I said, I better get a job between January and September. And I actually didn't want to take the moral equivalent in those days of a Starbucks job. I wanted a job with math content. So I managed to, you know, through my dad meeting somebody on a train on Long Island, got an interview at the Equitable. And math majors could do 3 things in an insurance company. They could do actuarial science, they could do computer programming, or in those days they had something called operations research, which was like an in-house problem-solving group using analytical tools to solve business problems. The day I started at the Equitable thinking I'd be working for 6 months and then going off to graduate school, I could have been assigned to work for the group dental team or group health insurance or individual annuities. I was assigned to work for the chief investment officer. I knew nothing about investments. I had a passbook savings account, but I loved it. There was so much math in it that I loved it. And so I deferred Hopkins for a year, and then I said, I'm not coming. And I went to graduate school at night, paid for by the Equitable in those days, and got my master's in math. There was a lot of math content my first 7 years. I was an analyst, and that's all I did. I took research and I translated it into tools for portfolio managers and financial analysts. I took a business course once, one business school course, forgive me, wonderful business school professors, but I only took one because my boss then, during this, going to school at night, which is the hardest thing I ever did, was getting my master's at night in math. He insisted that if I was going to take complex variables, I was going to take a business school class. So I did, I took one, but I really am pretty self-taught in business. But once I got the bug to actually run products and businesses, I was given the opportunity to be on a team to start a family of mutual funds in 1981. You're not going to remember this, you weren't even born, but 401k didn't exist when I started working. And it came on the scene through an IRS, someone discovered the area of the code that permitted 401k plans. I thought this was the best thing since sliced bread. I was in my 20s, and I just said, well, I'll start this. So I was starting products based on regulatory and legal changes. So, and you got a lot of that going on, so you have a lot of opportunities for new stuff. But once I got in the real business world, I found that selling and marketing and products became so much more important than the analytics in terms of getting the product out there. And I found I had to learn that piece. So today, my math is so stale, I'm afraid. I can understand performance statistics, but I don't really use it as a CEO. I have to understand financial statements, but I don't really use my math, but I did use it a lot in the beginning. Any math majors here? No? I think we've got...
Hi, my name is Alan Ellingson, and I'm with the MBA program here. One of my big questions about sustainable investing over the years has been how far do you track back business relationships when you think about investing them? And for example, BP, as a company, they've tried really hard, but do you look at Transocean? Do you look at Halliburton, who were in charge of the rig that Deepwater Horizon that exploded? I mean, how far do you track back before you decide, yes, this is a good company to invest in?
It's not an easy answer to that. I mean, you have to look at if bad things have happened in the past, is there a penalty box? I mean, I think we look just as hard at how companies respond to problems as whether or not those problems existed. And the denial phase is a lot harder for us to invest in when it's not their issue or they don't think they did anything wrong. But if a company is tackling their issues, they could be on our radar screen very quickly. And in fact, a lot of companies have done great work following problems. But so it's really incumbent on us to assess what led to that problem, and particularly as the board level. We are much more focused on governance and the top levels of the company now, and what is their approach, and how active is the board in assessing risk management, et cetera. So board evaluation tools are the kinds of tools we're really looking into now, board evaluation, governance tools. There's a whole industry growing around supplying data to investment firms like us. And we really, it's great to get a lot of financial data, but we like data like that, which helps us assess. But I will say there is a bit of a penalty box for companies that have major problems, and particularly when they're not owning up to it. I guess I could name some of the companies, but a lot of them don't, some of them don't own up to it. I think we had someone over here. Yeah.
Hi, yes. I'm AJ, an undergraduate physics major. And
Physics.
Yes.
Physics, great.
You've talked a lot about women in the workplace. As a guy who will be entering the workplace, what can I do to ensure that my female coworkers are successful?
What can you do? I'm sorry, I missed the last few words.
What can I do to ensure that my female coworkers are successful? You've talked a lot about what advice to women for how women can be successful.
I think the advice goes all across the road. I mean, again, the issue of meritocracy versus understanding that there's a lot more than that, and then leadership on top of that. That really transcends gender. We like to talk about 360s in business. That success is about peer relationships, managing up and managing down, and that I think is a universal. That to be a good supervisor and a leader and mentor for people that you're responsible for, to be a great team member, and also then to understand to manage up. And believe me, I still have all this as CEO. I mean, my up may be a little different from someone who just begins their career. My up is my board, but I tell people I have more bosses than I ever had because of all my board structures. And my peers are my team, those on my management committee. And then, of course, all the Calvert associates that work within Calvert. And it's not all about, to me, it's much more about understanding who you are and your own passions, strengths, and weaknesses, and really trying to make sure that you have an awareness of that in everything you do. And it's not about being a perfect person, by the way. I mean, I have a lot of weaknesses. I hope what I try to do is identify what they are, though, and fill in with with people who really are good at that, or good at particular have particular qualities. But self-awareness is enormous. You know, what am I doing to advance the company? What am I doing to advance the profits? How am I an ambassador for the sales in my company? Even if I'm in IT, you know, am I a good ambassador for my company? I like to do a lot on cultural awareness at Calvert, and you know, sales culture. It infuses any company that that ultimately has a product that's sold to the public needs a sales culture, and in our case too, investment performance culture, because even if you're not involved in buying and selling securities every day, and really most of our people do have a role in buying and selling securities, but even if you don't, you have to have an investment performance awareness, because that is what our ultimate product is to the public. So I think, you know, awareness of yourself and you know, what drives you and how you affect other people. And again, it's not about changing who you are. It's about knowing and making sure that you bring that awareness into the workplace and your interactions. I hope that's helpful. Never been asked that. That's in a way. Yeah, I think there's somebody over here.
How you doing? My name is Kevin. I'm with the MBA program as well. I actually went to Vanderbilt undergrad.
You did? All right. Go Doors.
So my question is, how do we as a society, you know, I'm looking at some of your slides and you're saying how, you know, companies that have, you know, more women on the board or 42% higher net income, you know, how do we as a society get more away from, you know, necessarily we need to have another woman on the board as opposed to we just want better people on the board, not looking at whether the women or minority or, you know, white male or whoever. Like, how do we just start looking at, you know, I'd rather just have the best people I can find and not worry about, well, we need one more of this specific type of person, so we're not going to take this person even though they're more qualified.
Yeah, that's a great place to end, because it is about getting away from, so to speak, that. But you can't get away from it till you recognize it exists and see that there's a norm there that may be driving the population into a certain place, that the norm. And you raise boards because that's a perfect example. The board selection process used to be board members just raising names of friends. Well, if the board is generally, you know, of a certain gender or a certain, and listen, it applies to anything. I'm not, you know, I really think diversity is good in all aspects. It strengthens decision making. And frankly, we had a board at one time at Calvert that was all women. I didn't think that was very good. I mean, we needed to have diversity on that board. But unless you realize that the norms are driving you to a certain outcome, you're never going to change it. So when you realize that, and you say, well, our process of picking board nominees is a bit flawed, because we went to the search firms. We said to Heidrick and Struggles, how come there aren't more women being on corporate boards? And they would say, well, we're not being asked for the woman. We're not being asked. So they don't present women unless they're asked. Well, that's not right either. So we said, well, what are we going to do? We can't change the search firms. We thought of this idea of having boards decide, nominating committees, that they will break that norm of how they get names for potential board members. They will decide proactively to have a diverse slate of, when we wrote to 4,000 companies and said we'd like to see more diversity on your board, we didn't say add a woman, add a minority. We said interview diverse slates, interview diverse slates, all the best people. And we think, you know, that will be, I absolutely am in agreement with you. I think if you do consider talent alone, you will wind up with diversity. I think it came through pretty importantly in this presentation, but I hope you also see it in the context of creating good companies that can sustain themselves in global markets over longer periods of time than the closing bell. But thank you for that question. Thank you.
Thank you, Barbara. On behalf of the college, thank you so much for being here.
Thank you, Jim. Thanks very much.